Hello guys, welcome back to my channel. Today in the class we are going to talk about traditional classification of the account. Traditional classification of the accounts tells which account is to be debited, which account is to be credited. For that particular base, we need to know what is the traditional classification. Traditionally, accounts were classified on the basis of the personal account, real account and nominal account. What is the personal account? As per the personal account, debit the receiver and credit the giver. The rule says debit the receiver, credit the giver. If I say X is receiving money from Y, so X is receiver, X account is to be debited, and money is given by Y, so Y's account is credited. So that is, as per the personal account, we need to debit the receiver and credit the giver. As per the real account, debit what comes in and credit what goes out. Whatever is coming into the business, that needs to be debited. If cash is received, then it is coming in, it should be debited. If cash is paid, it is going out, then it should be credited. So your real account basically deals with the assets. It could be a number of assets in the business. We'll discuss about this in the next videos. The next is about nominal account. Nominal account says debit all losses and expenses to the business and credit all incomes and gains whatever occurs to the business. Debit all losses and expenses if salary is paid, rent is paid. Fine. If something is lost by theft, then these all need to be debited. If rent is received, commission is received, incomes are always credited. Fine. So as per the traditional classification, debit the receiver, debit what comes in and debit all losses and expenses. So personal account, real account, nominal account, first part is for your receiver comes in and losses and expenses, and second part is opposite version of the same, credit the giver goes out, and the last one is incomes and gains. So here we go along the three divisions for the traditional personal, real and nominal account. That are the names to the accounts. Now when we have to deal for these three accounts, how they are dealt in the transactions, that we are going to learn today through the three given journal entries, where he talks about building is purchased for cash, rent is paid but obvious must have been paid in cash, paid to Zen, this must have also been in cash. In all of these three cases, you can see that cash is moving out of the business. Out of the business, when cash is going, we need to credit that particular account which is moving out. Here cash is moving out, so we will credit which account, that is cash. So in all of these three transactions, which account needs to be credited, that is cash account here in all of these three cases. Now the part is which account needs to be debited here. When he says for the first case, building is purchased. Building purchased for cash means building is coming into the business and cash is going out of the business. Building is coming, cash going out. Both are real accounts where it says debit what comes in and credit what goes out. The next part of the transaction is rent is paid. When you are making a payment for rent, rent is the expense of business. So which account is to be debited here? Debit all losses and expenses. So here rent account needs to be debited. What is going out? Again for rent we are paying cash. So cash was real account which was going out, so we credited it. But why cash was moving out? Because we made an expense. Expense goes to which account? Nominal account. That's why it has been debited. The lastly he said paid to Zen. Business is making payment to Zen. Zen is receiver for the business. So Zen here is the receiver for the business. Which account needs to be debited? Zen. Receiver is debited as per which account? That is personal account. So personal account here, he is the receiver. That's why he has been debited. And cash is going out. That's why credited. So in all of these transactions, when Zen is the receiver, debit the receiver. Debit what comes in, building is coming to the business, debit all losses and expenses, rent was paid. That's why these three accounts have been debited, but credit to each account was similar in all of these transactions. We'll do the concept later on in the videos. Thank you for the day. Accountitude, like, share and subscribe. Keep scoring.